How's it going?
Hey, it's going great. How have you been?
Oh, good. Hey, so I wanted to talk to you today. I've been seeing people talking about when they want to go ahead and buy a house, they can go ahead and feel confident getting into that house, even at today's rates, because they can always refinance
Yeah,
later. And so I want to talk
right.
about that portion about it, about refinancing. Could you give us like a little definition of what refinancing means?
Sure. So the logic of that is, rates have gone up. They will come back down. They may not get to that 2 or 3% like they were before, but certainly they can get down into the fives, even the 4% range. And the reason for that is that the Federal Reserve has been raising rates because the economy is running hot, right? It's a robust economy. There's labor shortages, people for to actually take the jobs. There's just a lot going on, a lot of pressure on pay increases, which is pressuring goods and services, which is causing inflation. So the government's trying to slow that down. When they slow it down, they will level off, and then they are going to try to stimulate the economy, and they're going to lower rates in order to stimulate the economy, and then they're going to try to find a happy medium there, right? The whole point is that the rates have come up, and they're going to come back down at some point because the government will be successful in slowing the economy. That's the one thing that we know. They will succeed at that eventually. So refinancing is just it's resetting the loan, it's resetting the interest rate. There's a couple of pitfalls that you want to be aware of, but essentially that's what it does. It takes that finance that you did at 7%, and if the going rate's say 5%, you're refinancing and turning that debt into a 5% payment, which is going to be quite a big savings. Depending on the loan size, that could be anywhere from $200 to $500 a month. So it's
Right.
significant.
Okay. Yeah, that is a big deal because there's four components that go into your monthly payment. There's the principal, the interest, the taxes, and the insurance. And so
Right.
if you change that interest portion, that can really have a good impact month to month and then, for the
Right.
whole year. That's what you're saying. Uh-huh.
It's that, and over the life of the loan, the savings really does pile up. So if you keep that loan, if you're only going to be there a year, it may not make sense, right? But if you were going to be there for 5, 10 years, of course you're going to save quite a bit of money.
I see. Okay. So if you're thinking about like you're going to get ready to sell anyway, and if you're thinking about maybe selling in the next year or so, it doesn't make a lot of sense to refinance.
It may not, right?
Okay. So does it happen automatically or does a borrower have to request that?
Well, typically with my borrowers, I'm going to send them a notification. In some way, I'm going to reach out either via email, mass text, or I'm going to give them a call if refinancing will benefit them.
Oh, great. Okay, good. So they kind of can be assured that at least Lake Michigan Credit Union is going to reach out to them and help
Yeah,
know when the time, because I think that's part of the challenge is like timing the market and knowing like, okay, well, they've come down, 3/4 of a point. Should I wait a little longer? What's
right.
the rule of thumb? Like how far down do they have to come before it's a good move?
Sure. So it can typically I want it to break even within a shorter period of time. So if you're going to refinance, and the closing costs are pretty standard, but you want to break even within a window of 1 to 3 years. You don't really want to go long term on your cost versus reward. That break even point needs to be a little bit sooner, which is why we're discussing that if you're selling within a year, it's probably not going to make sense because your break even point may be out at 2 years. That said, that's the rule of thumb that I use. It's not really the amount of decline on the interest rate because that will differ based on the amount of the loan, the amount of savings. So a really large loan doesn't need the interest rate to drop very far to make a $200, $500 savings per month. A smaller loan would need a larger movement on the interest rate to save sufficient funds on a monthly payment in order to make it make sense.
Okay, that makes sense. So let's kind of explore something that you just touched on briefly. So there are closing costs
Yeah.
again.
Some of the things that you have are your credit report, your flood certification, your title commitment, title closing fees. All those things are required for the loan, and an appraisal may be required. It depends on the type of loan that you have as well as whether or not you get an appraisal waiver. That can be a part of the approval that we receive from either Fannie Mae or Freddie Mac. If you have a jumbo loan, something that's not saleable to Fannie Mae or Freddie Mac, that's loans at this time over 715. You would not get an appraisal waiver. It's just not something in the jumbo space. But conforming loans, you can get that. It doesn't guaranteed, but you could. A lot of refinances do, so you save money there. Overall, your costs are going to be somewhat discounted in a refinance than they would on a purchase.
Is there a percentage that you could look, kind of have in the back of your mind, like 3% of the loan or?
Oh, yeah, no, because the loan sizes will vary and the costs are pretty much the same no matter what. Your larger loans are going to be closer to $3,000 in closing fees. Your smaller loans are going to be closer to $2,000. And then if you don't have an appraisal, that would come off of there. It really depends on the size of the loan as to whether or not you'd have any significant costs. Now, it also can be absorbed by an interest rate. So if the interest rate's dropping a lot, you can temper that a little bit and cover those costs. That's shorter term. That makes a lot of sense. But for a longer term home, generally customers pay the closing costs, not necessarily out of pocket. It can be rolled into the loan.
I see. Okay. So when you're talking about kind of breaking even, you're taking a look at, on the one hand, the closing costs. So maybe like $2,500 to kind of use a middle figure of what you're describing. So like $2,500, and then seeing how long it would take, with the savings for the interest for that to make sense.
Exactly.
Got it.
Exactly.
Okay.
So if you were saving $200 a month on a refinance, that's going to be pretty close to $2,500. That's $2,400 in your first year. Mm-hmm. Your break-even point is going to be just that short year period.
Okay, got it. Okay, and you're able to help people figure out if the timing is good for them on that.
Right. Now, when you're refinancing, part of that question is, do you refinance to a new 30-year fixed, or do you refinance to where you currently are on the spectrum of payments? So if you've been there a couple of years and have made 2 years worth of payments, and now you have 28 years left on your 30-year loan, you may want to refinance to a 28-year term versus a 30-year term. Does that make sense?
Yeah, but tell us why that might be advantageous.
Keeps your amortization spot so that you're not extending your loan time. It's generally going to save you more interest. It won't necessarily make your payment cheaper because you're shortening that window, but it does save you interest over the long haul. And we can calculate that out with an amortization table and show how that all works.
Got it. So you don't have to go back to the 30-year if you've already put in a couple of years on the loan.
Right. And the shorter the term of your initial mortgage, the more the interest rate would have to drop in order for it to make sense, because your amortization is moving a lot quicker. So for like somebody does a 15-year right up front or a 10-year right up front, and they are a couple of years into that, to make sense to refinance, it really takes a large movement in the interest rate because the loan is amortizing so fast.
I see. Okay, that makes sense. So that makes me have another question. Can you refi any type of loan, or does it have to be conventional only? Can you do an adjustable rate mortgage?
Sure.
Oh, okay.
Yeah. So that leads us to what we're doing today. A lot of the loans that we are doing are adjustable rate mortgages. They may have a fixed period of like 3, 5, 7, or 10 years. Mm-hmm. Those are really popular because, one, they're a discount off of what the current 30-year fixed rate is by at least 1%. And that's for a longer term fixed adjustable rate mortgage. So you've got that, let's say a 7-year. It might be as 1% less than that 30-year fixed. And it's fixed for 7 years. You can refinance that then to a fixed rate loan later on when rates come back. And the bet is that rates would come back within that 7-year window. And I think that's pretty safe. Mm-hmm. We have the Fed right now, topping out on interest rates, and it's probably going to result in slowing our economy this coming year, which will result in the Fed pivoting and starting to lower interest rates to try to create a soft landing. If they get into a recession where they have to drop rates a lot, that will also translate into the marketplace. And I think people will be able to take advantage of refinancing If not in the next 6 months, probably within the next 6 months to 2 years total.
So when someone's getting ready to refinance, there's going to be some cost associated with it. They'll have to talk with you
Right.
about how many years now they're going to be looking at for is it technically a new loan?
Yeah, totally new loan. Yep.
Okay, so they'll have to talk about how many years that brand new loan is going to be.
Right.
How long does this process generally take? Is it something that can be done in an afternoon, or does it like
The application can be done fairly quickly, of course, especially if you're going back to your servicer. We tend to have all that information, so we just update it. But yeah, from application to closing on a refinance right now, it's less than 30 days. When your volumes were up where they were the last 2 years, it was more. At one point in 2020, it was more than 30 days. It was probably between 60 and 90 to get your loan closed, just because so many people were doing it at the exact same time.
Well, yeah, I mean, if you wanted to take advantage of the 2% rates, that was a great. We actually
that was a good time.
Yeah, we refinanced during COVID, and we had a notary come to our house at like 10:45 at night so we could hurry and sign all the papers before the date changed. It was wild. What other things then should we know about refinancing? Is it a good option? Is it a solid option?
Yeah, generally speaking, if you're improving your interest rate and or improving the term, shortening it, what you're looking for is overall long-term interest savings. Most of the time people will pay those closing costs. It makes sense, and you break even relatively quickly.
Great. Thanks for all the information.
Yeah, sure. Anytime.
Okay, great. So if you find the perfect house and you want to get into it, I can help you with that. And I can help get you with Brent, and he can help you with the financing part of it too. And let us know if you have any questions. Thanks, Brent.
Hey, thank you. Bye-bye.